Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek with Massar and Tim Stenovec on Bloomberg Radio.
All right, well, some guests need no introduction, and joining us right now on Bloomberg Radio and also on Bloomberg Television, we're delighted to have back with us, of course, ARK Invest founder, CEO, and CIO Cathie Wood. We wanted to actually talk to her because there's so much going on, certainly this week, whether it's today when it comes to the jobs report, but it's also what's been going on with OpenAI. So, Cathie, great to have you here with us. How are you?
I'm great, Carol. Thank you so much for inviting me.
Well, it's good to have you here. There is a lot going on, and we were saying, obviously, we want to kind of start macro, which we often do with you. And first up, the upbeat labor market, the Fed finally now cutting interest rates. You've been beating the drum for some time about the Fed to cut rates. At the same time, we had former Treasury Secretary Larry Summers out saying the half-a-point cut was a mistake. Stanley Druckenmiller, the hedge fund billionaire, he believes the Fed shouldn't have cut rates at the most recent meeting. He thinks that the central bank has boxed itself into a corner by guiding for even more rate cuts ahead. Do you think the Fed rate cut was a mistake?
Absolutely not. Not at all. It's been very interesting to watch the revisions in economic activity. Until this report, the revisions in the employment numbers had been down, and they were much weaker than had originally been reported. You know, we look at earnings reports and look at their revenues, and we're seeing a lot of companies showing negative revenues. So, you know, the headline numbers are heavily influenced recently, certainly in terms of some of the upward revisions in personal income by transfer payments, that's government stimulus, and interestingly, dividends. But not if you look at the economy, the cyclical part of the economy is sick. It's sick. If you look at the sectors in the economy, one by one, they've been falling into a recession, no matter what the headline numbers say. Housing went down immediately when the Fed started raising rates. We're down 20 to 40% still. That's a recession. You've got non-residential construction in recession, autos, very weak.
Cathie, I know it's a backward-looking number, but then what do you make of today's payrolls report? 254,000 jobs added to the economy for the month of September. And that doesn't seem recessionary.
So if you just let me finish, Tim, I'll get to that in 1 minute. So we've got those sectors, and then you've got the small and medium business sector. Their confidence is at 08-09 levels. And we've got certain pricing measures, certainly the cyclical ones, that have been deflationary, actually. So one thing that I do think is going on that is helping is as prices are coming down and the consumer's getting better and better deals, and they're spending. So I think that is sustaining. You know, a lot of people say real growth causes inflation. In this case, and actually in history, most times if you cut prices, you'll get more activity. The consumer, as long as the labor market hangs in here, and yes, today was very reassuring that way. As long as the labor market hangs in here, and companies like Walmart and Costco and auto companies either increase their discounts or cut their prices, I think the activity will come, and the labor market will continue to hang in. But if they try and jack prices back up, it was very interesting to see FedEx, after turning positive in revenues and then turning negative year over year on revenues, basically saying they're going to use prices to make it up. I think that's going to backfire. And I think during the next year, that many people will understand how deflationary the undercurrents are in the economy. Now, deflation is not always bad. Part of it is because of innovation. technologically enabled innovation. The car prices, EV prices are coming down. Their costs are coming down too. So I think there's a lot of confusion in terms of what's going on out there because productivity is stronger than expected, giving companies the latitude to cut prices and salvage margins. If that sustains, great.
Cathie, when we talked with you earlier this year, let's go back to March for a moment. You mentioned the possibility of inflation going negative this year. You also talked about unemployment going above 5%. Are those still your calls?
Yeah, this year, I mean, we're going to have to push it out because inflation did levitate as companies tried to price to make up for shortfalls in unit growth. It levitated in the 3.5% to 4% range. Now it's broken below 3%. And we're hearing more and more companies, basically trying to attract consumer attention with lower prices. So yes, if you look at money growth on a year-over-year basis, it was negative for, I think, about a year and a half, maybe more. Money is a leading indicator for inflation, and we do believe that inflation will go much lower than people expect right now. Wouldn't be surprised to see it go negative, especially if the consumer is worried about job loss, whether because of AI and automation generally, or what have you. So the saving rate tends to go up during those periods. And that will mean, we believe, that companies will have to price even more aggressively. In terms of over 5% unemployment rate, we could see it. We could see it. I will say today gave me pause in terms of this productivity dynamic and sort of companies may not, if they get the productivity growth from existing employees, they may not feel like laying them off. They can lower prices to keep consumer demand going.
Hey, Cathie, election front and center. We're just a month and change out from the election here in the U.S. And I'm wondering how this dynamic, in your view, changes whether President Trump is reelected or we see a Harris administration. And
I wonder who you would support, too, in terms of what you think is good for the U.S. economy and America.
Okay, so our focus is on innovation, and something very important happened this past year. We were very concerned that excessive regulation was driving innovation off our shores, particularly when it came to crypto or digital assets. We've had a very hostile regulator. And the same, I would say, is true of the FTC in terms of denying M&A, because that has prevented a lot of innovative companies from enjoying liquidity events by selling out to bigger companies. I think we're hearing from both candidates that those two jobs are on the line, maybe for that reason. And we're seeing more alignment that innovation solves problems, and so we should not discourage it. So from that point of view, I'm happy to see the bipartisan movement here. We'll favor lower regulations every day when it comes to innovation. I don't think tariffs are a great thing at all for innovation and for economic activity. So there's something on both sides that will give us pause. But the most important thing is the biggest impediments to innovation. We think that we're developing clarity around what's going to happen at the SEC and the FTC.
So do you think one thing is better than one of the candidates, I should say, is better for the investment environment, for companies versus the other?
So here I'm going to revert to being the CEO of a company where, I'm representing both sides, and I'm focusing, therefore, on innovation, which is of primary concern to us. And I've given you a sense of where we think both sides are on innovation. Regulations, the one that will lower more regulations, because regulations are strangling this economy, strangling small business, strangling big business. That's a very important one.
Well,
Tariffs would be harmful as well. So
fair enough, fair enough. Well, let's talk innovation, which is your world. AI, big news this week. OpenAI's raising $6.5 billion in new funding, $157 billion valuation. ARK put in $250 million. The Wall Street Journal reminding us that that's the minimum amount required to open up their financial document. So why this investment? Why are you interested? And what did you learn about the company and its growth trajectory, or about the business, to be quite fair, looking at those financial documents?
Well, we've been doing research on AI for 10 years now. That's why we were so early into NVIDIA. And, we've obviously taken it down in most of our portfolios out of the flagship. One of the things that we've been looking for is the next big play. And we think NVIDIA is still a fine stock, but in terms of the unexpected out there, we do think it's going to be in the software layers. And as you know, Palantir has become a big position for us in the top 10. UiPath as well, it had a stumble, but it's coming back now. And I think as more and more people understand how well positioned it is, it will do very well. But a lot of the software companies that we think are going to benefit are in the private sector. And I'm thrilled that we have a venture fund that is really our purpose here is to democratize venture capital so that for $500, anyone can get access to OpenAI, which is the third largest position, or SpaceX, which is the largest position. But if you look at software, many people say, well, we have so many software companies in the public markets. What do you mean? And what we mean by that is we think that the software world's going to change fairly dramatically. And we're going to see a shift, maybe a share shift away from software as a service towards platform as a service. So think about Palantir and foundation models, and infrastructure as a service, so cloud. And the reason for that is because engineers are going to be made so much more productive, developers so much more productive by OpenAI and Anthropic and xAI and Google and Meta's Llama 3. We're going to see companies customizing their own software, customizing software for their own companies, as opposed to just going automatically to, one size fits all software as a service.
Hey, Cathie, forgive me. We only have a couple minutes left, so I want to get in a few more questions here. I don't mean to keep interrupting you. But you mentioned closing out your stake in NVIDIA. You did that in the flagship ARK Innovation Fund last year. But you also told us back in March that you used some of that to buy into Coinbase. Since February of 2023, Coinbase is up a bit more than 150%. No question, a great return. But NVIDIA up nearly 500% since that time. Do you regret that move last year?
If you had if I had bought both Coinbase and NVIDIA and sold something else, would I have been happier about that decision? Sure, I would have been happier. Actually, from the time we bought Coinbase to the time maybe we were talking to you or whenever we measured it, Coinbase actually had done better than NVIDIA. It has come back in. NVIDIA's had another big run. But we're now really focused on the future. And so software to us is going to be a huge opportunity. Foundation models, we think, will deliver $15 trillion around that in the next 5 to 10 years in market cap. That's from a standing start. And we'll see what happens to NVIDIA over that time. I think.
Is there something that could make you buy into NVIDIA at this point? Or add it to your flagship? I mean, I know you owe some, but yeah.
Yeah. If the price came down, again, I think I must say one of perhaps my weaknesses in a momentum market is watching a lot of momentum drive the stock and realizing that a lot of people who never owned it are getting in and might be weak holders. So, that factored into my thinking. But, we enjoyed, we got into NVIDIA at 40 cents based on this stock in 2014. So, wherever we got out, we were extremely happy with it's been the third largest contributor to our flagship fund. So, tactically, sure, we would have loved to still have it, at a bigger position in the portfolios. But again, we're all about the future, and our research is focusing us on this software layer that has huge amounts of appreciation ahead.
Let's go to Tesla, number one holding in your flagship ARK Innovation ETF. It's down about 40% since an all-time high back in November of 2021. Little change year to date. When do you decide, in terms of Tesla, it's a different market, an EV market. You understand, what's going on in that marketplace more than ever. What is your thinking about Tesla today? You've got an estimate of $2,600 a share for 2029. What gets us there? And just quickly, sorry, we've only got about 30 seconds.
Autonomous mobility, think 1010, October 10th here. That is going to focus analysts not just on EVs, but on the autonomous opportunity. Tesla is the largest AI project in the world. Talk about shifting resources from NVIDIA into Tesla. We think longer term, that is going to prove to be a very good move.
We know you have to run. So appreciate your time. Be well. Cathie Wood, of course, of ARK Invest, joining us right here on Bloomberg Businessweek on radio and TV.